We're almost a year into the mortgage regime under the MMR, and so this is a really good opportunity for us to stop and reflect on what the impact has been and whether all those scary headlines that we were reading a year ago and all the doom and gloom forecasts we were reading were in fact right. I mean, from my perspective, I think overall the majority of firms have made the transition pretty successfully, given the scale of the change that we've just undergone. Excuse me. The year has proved in the main to be business as usual for firms. Lending has continued to recover slowly from the post-crisis slump. The supply of mortgages has continued, and creditworthy customers are still managing to get mortgages. Processing times seem to be getting better. I've gone and spoken to firms who've admitted that maybe they over-engineered their processes a bit, and I think that things do seem to be gradually bedding down. One of the things that I really like to do when I get the opportunity to come out and speak at events like this is to share with the market the data that firms report to us regularly. And I think that probably gives us quite a unique insight into what's actually going on in the market. So I'm going to use that today to have a look at what's actually happened in the market over the past year. No, I need to use this though to be able to do that. So you can see that lending, although still some way below the longer term transaction levels, has held up during 2013 and 14. I think it was particularly strong last year. 2013 was a strong year, but it's fallen more in line with seasonal trends last year. But the market is continuing to grow, as Robert was mentioning this morning, and I don't think anyone can say that it's stalled as a result of the introduction of the MMR. I've included some data from the Glasgow area, just to give some local flavour. And you can see that the overall trends are pretty similar here. One of the notable things that's happened, and this happened after the crisis and not as a result of the MMR, has been the clear shift in lender appetite towards house buyers and away from existing homeowners. What we've seen post-crisis is lenders focusing back on the house purchase market. So here you see it's really particularly strong, sort of bucked the trend a bit. It's more or less in line with the longer term transactional levels, and it's continued really pretty strong. But you can see from this that it wasn't the second or subsequent home movers that was fueling the growth. Here you can see that lending to home movers has in fact been well below the 8-year average. First-time buyers, by contrast, if you look at the first-time buyers, that's well above the longer-term average for most of last year. In fact, last year saw the highest number of borrowers buying their first home for 7 years. So that's a particularly strong sector of the market, fueled a lot by the government's policies and Help to Buy. Remortgaging activity, by contrast, remains really subdued. And this is the side of the market, as Robert was mentioning this morning, that's proved to be the unsustainable side. And while we will, and I think we will see it come back as interest rates start to rise, it's unlikely ever to get back to anything like the levels we saw pre-crisis. So why are the remortgaging figures persistently low? One of the reasons we've seen being given for borrowers not remortgaging is, quote, because of the rigmarole of the MMR. Frankly, I really don't think that borrowers know about the MMR. The reason the creditworthy are not moving is more likely to do with the fact that at the end of their fixed period, they were happy to move on to their lender's standard variable rate, thank you very much, while interest rates remain low. And we're even now hearing speculation about base rates possibly going even lower. Most borrowers are going to be happy staying where they are. Why would you go through the rigmarole of remortgaging when you are paying a low and perfectly affordable rate today? So here you can see the number of borrowers on variable rates. It was 54% at the end of last year, but you can see that it had reached 68% in around 2012. Sales today are mostly fixed rate products. 83% of sales at the end of last year were fixed rates, and they are likely to remain the popular choice on the expectation of future interest rate increases. For those borrowers with more complex borrowing needs, who were previously able to use specialist lenders and products to access the market, excuse me, the answer about why they're not remortgaging is easy. They are now faced with a lack of equivalent product and lender choices, and they can't remortgage even if they wanted to. Post-crisis, the number of non-banks, which had accumulated quite a large market share, I think they accounted for something like 9% of all regulated mortgage sales pre-crisis, well, they simply exited the market. There were 30 non-banks in 2007, and today there are 15. Those lenders serviced the borrowers who found it most difficult to obtain mortgages from high street lenders, and so those borrowers are left with very little choice today. And the fact is that growth in future can no longer come through allowing borrowers to self-certify their income. Affordability can no longer come through stretching affordability through interest-only mortgages, where there's no verifiable source of capital repayment. And credit can no longer be so readily extended to those highly marginally credit-worthy customers who were already heavily indebted and were always going to struggle to repay. Lender appetite has changed significantly in the immediate aftermath of the crisis, when we saw a flight to quality and improved lending standards. And as Robert noted this morning, we were all having a party, and suddenly the music stopped and the punch bowl was taken away, and we all sobered up sharpish. This is not going to be a temporary change ahead of getting back to normal. The MMR, of course, does change things. In the interest of ensuring we have a sustainable market in the future and that it works well for consumers, the MMR is not going to allow lenders to go back to the lax lending standards we saw pre-crisis. That means, however, that many of today's borrowers' choices are going to remain constrained because there's going to be a mismatch between their risk characteristics, which were perfectly acceptable to lenders pre-crisis, and what's available to them today in terms of products. So you can see that the prime product numbers are back at pre-crisis levels. So customer choice and access is increasing, but lenders today are introducing products across increased numbers of LTV tiers. And while pre-crisis the market was dominated by the high LTV scale, in particular 90 to 95%, the focus in the competition today is on lower LTV products and the quality, less risky end of the market. So here we can see what's actually selling versus what's being marketed at the end of last year. And the left-hand table shows marketed products and purchased products by maximum level of LTV, and you can see the spread available. It's about a 50-50 split between those being sold below and those being sold above 70%, although most products being marketed are in the 75 to 85 bracket. The very few products, as you can see down here, the very few products being marketed at 50% LTV are all subprime products. It's also interesting to see that 2-year fixes remain the most popular product, although 5-year fixes have become increasingly attractive for reasons that we're going to have a look at later. And of course, we have already seen fixed-rate mortgages are way outselling variable rate mortgages. So who's actually getting these mortgages? Well, this, I think, clearly illustrates the flight to quality I mentioned earlier. It shows the percentage point shift in lending to different customer types between 2007 and today. Those who've gained, the green, are the wealthy or the midlife affluent. Those who've lost out, the red, are the on the breadline and the credit hungry. But actually, when you look at lending overall and the customers who are getting mortgages overall, you can see that the credit hungry are still making up the majority, 16% of the market. The majority of the market is still credit hungry. And I think this helps show the structural shift that happened in the market post-crisis. In the run-up to and post-MMR, the year of here, nothing has actually shifted. Nothing has changed in terms of the customer type getting mortgages. And all customer types are continuing to get mortgages, much as they did previously. But you can see the slight cooling trend starting around 2008 towards the credit hungry. So you can see the colour changing gradually from around 2008. And you can see on the corresponding warming up towards the wealthy and the more affluent types. So here you see the wealthy and more affluent gradually warming. But there certainly has been a major structural shift when it comes to distribution. And here, I don't think there can be any doubt that the MMR has had an impact. Advice is a core part of the MMR, and as a result, we've seen intermediary share of lending grow to 62% by the end of last year. In some sectors, of course, it's already way beyond 62%, and in fact, coming back to pre-crisis levels. Those borrowers with more complex needs, such as the self-employed, the interest-only, those wanting to borrow into retirement, those consolidating debt, or the credit-impaired, all seek the help of intermediaries to source suitable products for them. I think this slide shows neatly the overall move back towards intermediaries from around the middle of 2012. Higher risk sales, they moved in-house and were subject to much closer control by lenders immediately post-crisis. But there's been a gradual shift back, which has gathered momentum since about the middle of 2012. And of course, the MMR removed the non-advised sales process. And here you can see the number of advised intermediary sales has increased considerably since the beginning of 2013. There were a number of mortgage intermediaries in 2007 who sold mortgages only on a non-advised basis, so exclusively non-advised. There were 199 of them, in fact. We've been particularly interested to see how they've adjusted to the MMR. And as you can see from this, 168 seem to have decided that providing professional support and advice to the customers is not for them. And so they've left the market. Although they could have phoenixed into other firms, and they could still be active in the market, and it's not possible for us to link their lending back to what they did previously. It's also important to note, I think, it's important to say that, of course, those intermediaries selling on an advised basis have also reduced considerably in number. Overall, the number of intermediaries has halved since 2007, from 12,100 firms to 6,300 today. You can see that 15 of the firms have made the transition into the brave new world and are selling on an advised basis. And interestingly, 6 continue to provide a predominantly non-advised sales service. We were interested in having a closer look at that and trying to understand exactly why and what was going on, and drilling down more closely into those particular 6 firm sales. We can see that the volumes were very low, and it does look as though they fell into one or other of the exceptions, which there are, where an interactive sale doesn't need to be advised, i.e. sales to mortgage professionals, high net worth borrowers, or business borrowers. But we've always had a concern about the risk that an execution-only service could be used as a means of circumventing the more rigorous advice standards under the MMR. It's important that it's used to service those customers for whom it's been designed, i.e. those customers who are well able to make an informed choice about which service and product they want. So this is an area that's going to stay on our radar. We expect firms to effectively manage and monitor their execution-only business and have in place processes and procedures for ensuring compliance with the new rules. But when it comes to advice, by far the biggest change, of course, has been in direct sales. And here you can see the dramatic shift towards advice as lenders have changed their sales practices in response to the MMR. So it's good news. Demand for advice is high. It's good to see intermediaries busier than ever. In fact, there are now some concerns that there's not enough capacity in the market to cope with increased volumes. And just a word of caution about that. In the past, we saw some firms cutting corners in order to cope with increased volumes. And it's just something to think about. It would be good to see all the hard work and effort and improved standards we've seen in the market post-crisis being maintained and care being taken not to let standards slip. So you're playing an increasingly important role in this market. Buying a mortgage is, of course, one of the biggest financial decisions a consumer ever makes, and the vast majority of consumers need help and support through the buying process, and they look to you. And it's not only on the advice side, it's also on the responsible lending side, where the real value you add is your extensive knowledge of each lender's application of the affordability rules, which helps you meet your client's particular needs. The MMR sets a basic minimum framework around affordability checks, and so lenders have flexibility about what to take into account in their assessments. And so affordability calculations differ greatly between different lenders. This can lead to big differences in the maximum loan amount that lenders are prepared to lend, which of course makes it really difficult for you to advise your clients on their borrowing capacity. And now that lenders are clearly on the hook for checking affordability, you now also have most lenders asking for a lot more information and being a lot more demanding when it comes to standards of packaging. All of this, I'm sure, can be frustrating and a real challenge, but things are hopefully continuing to bed down, and I really hope that you can see this as an opportunity where you can show the real value you can add in sourcing products for your clients. I suspect some of the frustrations may be behind the fact that, notwithstanding the market picking up and the growth in intermediated sales and a more positive outlook in general, we do still read and hear concerns about the impact of the MMR and the fact that it's stopping borrowers from getting mortgages. So, for example, IMLA published its intermediary lending outlook research just last month, saying that renewed optimism in the mortgage industry is being overshadowed by the view among intermediaries that the market has become too conservative because of regulation. They reported that growing numbers of brokers were reporting difficulties in meeting consumer needs, and that 4 groups were impacted in particular: the self-employed, those seeking lending into retirement, interest-only customers, and those with an adverse credit history. So I wanted to take some time today just to look a bit more closely at those particular groups and the claim being made that it's regulation that's acting as a constraint on lending to them. Starting with the credit impaired. 53% of brokers who participated in IMLA's research were unable to help a client with adverse credit. I've already touched on the post-crisis move by lenders away from the credit-hungry customer type to the wealthier and more affluent type. And here we can see from the data what impact regulation has had on lending to the credit impaired. So the MMR came into effect on the 26th of April last year, though I think it's generally accepted that it actually was implemented many months before that by most of the lenders. But even if we go back as far as April 2013, there doesn't appear to have been any perceptible impact as a result of the MMR. And you can see it's exactly the same story here in Glasgow. What happened to this market happened post-crisis. And that's when lenders' risk appetite changed fairly dramatically. Across the different lender types, lending to the credit impaired has remained at pretty consistent levels. As you can see, the banks in particular have been pretty consistent in lending. You can see that non-banks have increased slightly at the end of last year. In 2007, there were some 8,000 mortgage products marketed specifically to the credit impaired. Today, there are 105. The table on the left shows the number of products available at certain LTVs, and the red, that's the products available to the credit impaired. The grey is the products available to those who are not credit impaired. And if you're lucky enough to find a suitable product, as you can see from the table on the right, the interest rate you're going to pay is about double that paid on a standard mortgage. Although the market share to the credit impaired was never very large, it was still quite material. There were, in 2006, over 90,000 mortgages sold to credit impaired customers. Last year, there were just over 2,500. So it's hardly surprising that some brokers are reporting they're having a struggle to help customers with adverse credit. It's high-risk lending, and lenders, frankly, are wary of going there. But it's wrong to point the finger at the MMR and regulation as a reason why lenders have pulled back from this market, when that pullback happened some 6 years ago. That's not to say that the MMR won't have an effect, because it will. As I said earlier, in future, it's no longer possible simply to self-certify your income. A proper assessment of affordability has to happen, and that's going to limit the extent to which lenders will be able to relax their lending criteria in future. And many of those highly marginally creditworthy customers who were able to get mortgages in the past won't be able to do so in future. That's not about lenders being more conservative because of regulation. It's about lenders being more responsible. I do think credit impaired lending can serve a useful purpose in rehabilitating some customers who have had payment problems. But we do not want, and I'm sure everybody agrees, that we do not want to go back to the poor lending standards seen in the run-up to the crisis, which left the credit impaired 13 times more likely to go into arrears than other borrowers, and 18 times more likely to have their house repossessed. It's a similar picture for interest only. 53% of brokers who participated in IMLA's research were unable to help interest-only borrowers. So what does the data tell us about interest-only? I mean, there has been a pretty steady reduction in interest-only lending since 2009. And again, you can see that the picture for Glasgow is pretty similar. Lending has held up pretty steadily since the beginning of 2013. So it's pretty steady. It's been a bit of a dip in the last quarter, but it's held up pretty well. This was one of the sectors where we were told that the bigger retail banks would withdraw from servicing customers because the underwriting requirements didn't readily fit with their largely commoditized approach to lending, and that consumers would therefore lose out. But while volumes have decreased, they are still selling interest-only mortgages. You can see that banks and building society shares were around 6% as a proportion of their total sales at the end of last year. For the non-banks, it was around 10%. And here you can see what products are available, and a clear shift towards lower LTVs, particularly if you don't have an investment-linked plan. The green represents the products available at particular LTV rates on a repayment basis only. The blue is where interest only with an investment-linked plan is also acceptable. And the red are those products where it's also acceptable to have no investment plan or downsizing at the lower LTVs. There are two distinct customer types who look to borrow on an interest-only basis. The wealthier households who use interest only for financial planning reasons, and lower income stretched households who use interest-only mortgages for affordability reasons. And at the height of the market in 2007, around a third, 32% of all mortgage sales were interest only, and around 75% of those had no reported repayment vehicle. It had become a way to stretch affordability. I think the two customer types have fared very differently following the crisis when interest-only lending reduced. And this slide shows the move of interest-only away from the low-income indebted types of customers to the wealthier types. Basically, what we've seen is interest-only going back to being a niche product for wealthier borrowers with lots of equity in their properties and the means to pay off the capital sum at the end of the term. In fact, the customer type for whom interest-only products were first designed. Turning to the self-employed, 46% of brokers who participated in IMLA's research were unable to help a client who was self-employed or had an irregular income. Because one of the most significant changes introduced by the MMR is income verification. As of the 26th of April last year, income has to be verified in every case. Self-certification is no longer acceptable, and neither is fast track. There was a lot of concern about the impact the income verification requirements would have on the self-employed. In 2007, 70% of self-employed customers obtained mortgages without having their income verified. So obviously, it's going to be a bit more challenging today. Underwriting these cases and making an informed lending decision based on what evidence there is of the borrower's income doesn't fit easily with the move towards a highly commoditized approach to mortgage lending, where it's a computer rather than an underwriter who makes the lending decision. And this was another area where we were told that as a consequence of the MMR, a number of firms were likely to exit the market, choosing not to service the self-employed because of the cost implications, and that the self-employed would be disadvantaged as a result. So what's happened? Well, as you can see, lending to the self-employed has remained at fairly consistent levels. In fact, I think it's actually on the increase. Following the massive drop-off in 2008. If anything, the trend, I think the trend has been upwards from the beginning of 2013, and we haven't seen the sharp reduction in volumes of lending to the self-employed that the commentators forecast. Other than the specialist non-banks, which we would have expected given their exit from the market post-crisis, all lenders have remained active in this market, and we've not seen the threatened loss of capacity. Retail banks continue to have the lion's share, with building societies maintaining fairly consistent levels. One of the challenges that I've had when I've gone out and shared this data with the market previously is that proportionally lending to the self-employed has reduced because of the increasing numbers of self-employed in the workforce today. So here's the proportion of the self-employed in the workforce today, and you can see it has been increasing in recent years with a notable pickup since April 2013, and it currently stands at 15%. But just looking back at the volumes, I think there is a corresponding pickup since 2013, as we saw. And I'm not sure that we would expect lending to the self-employed to actually increase proportionally with the share of the self-employed in the workforce. And that's because the recent increase in self-employment has been driven by the types of people who are more likely to be existing homeowners, including those owning their homes outright. In 2009, directors and other senior managers in professional occupations made up around 45% of the self-employed. In 2014, that had risen to 85%. The average age of self-employed today is 47, and as of June last year, 74% of them owned their homes and 33% owned them outright. There are lots of products available to the self-employed, and you can see that for lots of products, there's just no distinction drawn between employment types at all. Finally, lending into retirement. The IMLA research showed that some 50% of brokers were unable to help borrowers wanting a mortgage into retirement. And there's been lots of commentary in the press about older borrowers finding it difficult to get a mortgage. But our data doesn't support the view that older borrowers cannot get a mortgage. The proportion of loans advanced that extend beyond the age of 65 continues to steadily increase, particularly in the 65 to 70 age bracket. And here you can see that although it's reduced slightly, the percentage of transactions where the term is over 70, that's this line, was still at 6% at the end of last year. Mortgages, of course, were designed to help consumers to buy their homes and to be repaid on or before retirement. You can see that around 64% of transactions were still maturing at ages 65 and under at the end of last year. The majority, 33%, were maturing when the borrowers were under 60. As you can see, following a post-crisis fall from around 2009, lenders have been increasing the number of sales to the over 65s. Our rules are not designed to discourage lending to older customers. What matters to us is that the borrower can afford to repay the mortgage, whatever their age. This is a sector where we haven't seen a post-crisis slump, and frankly, I don't think lender policy has actually changed that much. The majority of lenders have always had a maximum age at maturity. The general maximum age today is 75. It's where the majority of the products are available, with lending beyond this considered on an exceptions basis. So lenders come and say to us that it's responsible to impose a maximum limit, and we do recognise that there is a general reluctance to lend beyond 70 to 75 for perfectly legitimate concerns about increased borrower expenditure, for example, care costs, affordability issues when one borrower dies, particularly the borrower with the main pension, mental capacity issues, and etc. We now require lenders to assess affordability, and the fact is that many consumers are likely to have a reduced income following retirement, and therefore may not be able to afford to repay their mortgages as a result of declining pensions, savings, larger outstanding mortgages, and increased levels of debt. Lenders were able to get around this previously by simply putting something on a warning in their mortgage documentation, but they can't do that any longer. So what we're seeing are links to state pension age where there is more certainty about income. On the 5th of December 2013, as part of the autumn statement, the Chancellor said that people should expect to spend up to 1/3 of their adult life receiving state pension. For a long time, of course, that was 65, but given changing demographics, this meant that the increase of the state pension age to 68 would be brought forward to the mid-2030s, and the increase to 69 occur in the late 2040s. And using the data for the age of borrower at the end of term, here we've illustrated how lenders have adjusted their lending policies to reflect this. The peaks follow the announced increases in state pension. We've got 69, 65, and it also shows where the lenders have imposed a maximum cut-off. Interestingly, cumulatively, the number of the people who want to pay off their mortgages before they are 64 is the largest number. Look at this. If you look at this cohort here, that's the largest number of people who will be paying off their mortgage. And a considerable number even earlier, under 55. The vast majority of people still want to pay their mortgage off early, and they don't want to be saddled with debt into retirement. As Robert was saying this morning, sadly it's going to be a very different story for today's younger people trying to get onto the housing market. The important thing is that there are lenders out there who will assess the likely ability of the borrower to work past normal retirement age, and you can continue to add value by helping your customers source those lenders and those products. So what else has been changing? Well, we've seen a noticeable move towards lengthened mortgage terms and increased loan-to-income and loan-to-value ratios. This is a closer look at the increase in mortgage terms, which, as you can see, isn't only being driven up by first-time buyers, which is what we are always told, but in fact, it's a steady upward trend across the market since around 2010, with a noticeable increase in line with the arrival of the MMR. I don't think there can be any doubt that mortgage terms are increasing because of the MMR, and because firms are complying with the MMR requirements and are being tougher on affordability. If a borrower doesn't fit the affordability criteria on a 25-year term, for example, then they may need to take out a longer term. That's a choice borrowers have to make. Longer terms aren't necessarily bad, but what matters is that the borrower understands very clearly what taking out a longer term means, the real cost to them in terms of interest payments and extra early repayment charges. And here you can see the trend in LTIs. There has been quite a considerable growth in lending above 4.5 times income. You can see how it crept up from just above 2% to 8.5%. So it's 2% to 8.5% by Q2 last year. And in Q2 last year, that's when the FPC announced its cap. Q4 was the first quarter when the cap applied, and you can see that the FPC's action had an immediate effect on the market. So we've seen a number of lenders introduce LTI caps. I don't think that's necessarily as a result of getting too close to the 15% threshold imposed by the FPC. I think these moves have more to do with the fact that lenders are picking up more high-income multiple business than they want to. Brokers are looking for a home for this type of business, so I think we're likely to see more lenders follow suit if they feel they're being targeted. That's the domino effect that Robert mentioned this morning. But I also think it's important not to lose sight of the fact that most borrowers, 65% of them, still borrow with LTIs below 3.5 times income, and around a third at less than 2.5 times income. That's where the majority of the market is. We hear lots of comments suggesting that the FPC move on LTI somehow undermines what we've done under the MMR, and it's a move away from an assessment of individual affordability back to the old income multiple approach. But that's not the case. The MMR actually specifically allows for an LTI threshold to be applied on an individual basis. So just to give a practical example of that, where following an assessment at an individual level, a firm establishes that the borrower can afford a loan that is, say, 6 times their income, for entirely sound credit risk management practices, the firm may decide to draw a line at 4 times income. And so it will use the MMR backstop rule to limit the actual amount the customer can borrow. This was happening irrespective of any action that the FPC took. So we started to see LTI ratios, i.e. the backstop, increasing. That's not to say that individual affordability wasn't being assessed as required under the MMR. It's just that if the customer was able to afford 6 times income, firms were increasingly willing to go there. And as a result of the FPC action, that might not be happening in future. The FPC move, of course, was for macroprudential reasons, i.e. the aim was to limit the overall exposure of lenders because of the stability risks, and not a conduct move, i.e. it was nothing about protecting customers from unaffordable lending. And here's the trend in LTVs. Again, we've seen this earlier. You can see the growth in the higher LTV brackets, notably in the 90 to 95% bracket. I also thought I'd share this slide on the growth in 5-year fixed-rate mortgage products. Is it any coincidence, I wonder, that the growth in 5-year fixes started when we first consulted on requiring monthly payments to be stressed against future interest rate rises if the fixed period was less than 5 years. Lenders tell us that it is the stress test that's had the biggest impact on how much borrowers can borrow. And the IMLA research that I mentioned earlier indicated that 63% of intermediaries believe that significantly more borrowers are being turned down as a result of the interest rate stress tests, and 79% believe that it has reduced the amount that can be borrowed. Lending at 5 years and above does not need to be subjected to a stress test. And I don't think it's a coincidence at all that we're seeing a significant increase in the number of 5-year fixed rate mortgage sales. I mentioned earlier that many of today's borrowers' choices are going to remain constrained because there is a mismatch between their risk characteristics today and what was acceptable to lenders in the past and what's available to them today in terms of products and what lenders are prepared to accept. This slide shows that those borrowers who find themselves trapped in their mortgage today took that mortgage out at the height of the market when lending standards were really very poor. It's not the MMR that has created mortgage prisoners. It's the poor lending standards we saw in the past, and basically we reap what we sow. It's really important to ensure that we don't have to go through anything like this again, and that we don't see lending pushed back along the risk curve, and that we don't create the same vulnerabilities in the future. Einstein summed it up neatly. We really do need to learn the lessons of the past, and I really hope that we have learned them. I mentioned the FPC earlier. The FPC was created out of the crisis to act on macroeconomic and financial issues that threaten long-term growth prospects. Clearly, they're not going to be prepared to allow things to slip back. They're prepared to take action, and we've seen that they step in and take action really pretty quickly, and it has an immediate impact on the market. The latest tools they want to have, power to deploy, what they've got their sights on, and in fact are going to get from May 2015, are LTV portfolio caps and DTI portfolio caps. This is going to give them the power to require the FCA and the PRA to restrict lenders from providing mortgages above certain LTV or DTI ratios. The purpose of this is to reduce potential losses to lenders through high LTV borrowers defaulting on their mortgages where property prices have declined. And the DTI tool would limit the number of borrowers whose high debt burden makes them more vulnerable to a rise in interest rates or a fall in income. Again, this is all for macro-prudential reasons. The aim is to curb future bubbles in the UK housing market. Buy-to-let activity has also been attracting the attention of the Financial Policy Committee. They want powers to limit risky buy-to-let lending as part of the tools they want to use to set mandatory limits on LTV and DTI ratios, not only for residential lending, but also buy-to-let. Interestingly, while the government has already consulted in giving the FPC the new tools to control residential mortgage lending, and we expect this to happen ahead of the election, it has delayed the consultation on buy-to-let. They're proposing to issue a separate consultation this year into whether the FPC should have these powers over buy-to-let lending. And the government has been very reluctant to regulate the buy-to-let market. For its part, the FPC has described the sector as a, quote, significant potential amplifier of housing and credit cycles, and warned that not including buy-to-let lending in the scope of its powers over mortgages could limit the effectiveness of its policy tools. And just staying on buy-to-let, when the government published the legislation needed to implement the Mortgage Credit Directive and to bring second charge lending from the consumer credit regime into the mortgage regime in January, it surprised the market a bit by including in the legislation a framework of conduct standards for buy-to-let firms. It had to do this to meet its legal obligations under the Directive to have a framework in place covering that sector. The vast majority of buy-to-let customers are not going to be affected because the government has said basically that if a customer is actively taking out a buy-to-let loan to purchase a property, with the intention of letting it out and receiving an income which will be taxed as business, even if it's their first and their only buy-to-let product, they will be regarded as acting by way of business, and so they won't be subject to the new legislative requirements. But of course, some borrowers won't be considered as acting in a business capacity, i.e. the so-called accidental landlords who haven't made an active decision to invest in a buy-to-let property, such as those inheriting a buy-to-let property or those deciding to switch the home they've been living in to let it out instead. They will be subject to the new conduct standards set out in the Mortgage Credit Directive from next March. And of course, where you buy a property to let it out to a family member, that is already regulated by us as a regulated mortgage contract, and so subject to the full MMR. So it's quite a messy picture now in terms of buy-to-let lending. The legislation which the government published in January applies directly between the government and the buy-to-let lenders, and doesn't give the FCA any rule-making powers whatsoever. So we can't, for example, modify the conduct standards that firms will be expected to follow. It does, however, give us powers to register, supervise, and where appropriate, take action against those firms carrying out consumer buy-to-let activities. We're currently consulting on the changes that we need to make to our rule book to give effect to all of this. But if you're an intermediary and you're going to be carrying on consumer buy-to-let activity, you have to be registered with us to do that from the 21st of March next year. The details are in the CP, which closes on the 19th of March. If you're already regulated, actually, it's a pretty simple process to go on the register, but I'd encourage you to have a read and see what that entails. Finally, just a quick mention of the other big change on the horizon. Almost a year from now, on the 21st of March 2016, the Mortgage Credit Directive is implemented. We've worked with the industry working groups to try and achieve an approach which, so far as possible, causes minimum disruption to the market. But there are some things in the directive which just are non-negotiable. So, for example, we know that we have to replace the KFI with an ESIS, a European Standardised Information Sheet. Financial promotions will have to include a lot of prescribed detail, and we will also have to show 2 APRCs, the one that we have today, and another based on the worst case scenario of the highest interest rates that have prevailed over the past 20 years. And there's also a new 7-day right of reflection for customers introduced. So there are unavoidable changes ahead, notwithstanding that the directive is on the whole aligned with the MMR. Second charge lending will move to the mortgage regime from the consumer credit regime when the directive is implemented. And I mean, the proposal is that regulation of the second charge market will be brought in line with the first charge market. So basically, we're tucking it in to the first charge market. I'm not in a position, unfortunately, to say very much more than this about the directive, because as Robert mentioned this morning, the final policy and rules are expected later this month. If you want to know more about it, there is a dedicated mortgage credit directive page on our website, which provides information reflecting the changes for second charge firms, including a webcast highlighting the authorisation process. So I'd really encourage you to go and have a look at that. You're going to have to get yourself registered to do second charge lending from March next year.